Hi, good afternoon. My name is Ramendra Bhatia, and on behalf of ASK Investment Managers, I welcome you all to ASK Emerging Opportunities Portfolio, Emerging Opportunities Funds Quarterly Update Call. Today, when we are facing extremely volatile world environment, markets reacting to near-term news flows, FII is taking money out. After peaking at the end of September 2024, markets have been in correction mode. All indices, including large, mid, and small, have corrected significantly. Although over a longer term, markets are driven by earnings and cash flows. Today, we have with us Mr. Chetan Thacker. Mr. Chetan Thacker is Senior Vice President and Portfolio Manager. Chetan has a total work experience of more than 16 years with 13 years plus in equity research. He has a sector research expertise in agriculture, chemical, metal and mining, and mid caps. Previously, Mr. Chetan Thacker has worked with McKinsey and Company, HSBC Invest Direct, MK Global Financial Services. His education qualification includes CFA and PGDBM from NMIMS. He is with ASK since 2015. Today, we have scheduled this webinar when I would request Chetan to cover the broader trends in the market, followed by deeper understanding of the ASK Emerging Opportunities Portfolio and Emerging Opportunities Fund, giving an insight on what happened till now in this financial year, where do we stand now, and how we see things going forward. This would be followed by Q&A. I would request all of you to type in your questions and queries related to the portfolio, and we shall curate and try to get them answered. So Chetan, thank you so much for joining in, and all over to you.
Sure. Thank you so much, Ravinder. Thank you everyone for joining us this evening for this quarterly update call on the EOP portfolio. Like Ravinder mentioned, I'll take you through a brief presentation and then we'll open the floor for question and answer session. So just to begin, I think the first question that is there on everyone's mind at this point of time is what has happened to the market, particularly in the last 2 months, which have been faced with significant volatility. I think 2 or 3 things have played out together. One, to begin with, was the fact that we had already started to hear that there is a slowdown post the festive season, and we are not seeing the kind of recovery that was expected and a follow-on demand on the post-festive period, which is one reason where we felt when we spoke in the last quarterly call also, we said that we anticipate a cut in earnings estimate for the street, given the feedback that we were getting from the ground. As far as the third quarter results are concerned, which have just gone by, I think the slowdown in consumption is quite evident. We are actually seeing sluggish demand as far as the consumption sector is concerned. Having said that, we've seen certain measures that the government has taken, particularly in the union budget related to tax cuts. We'll cover that in the slides ahead. The second big factor has been the volatility that is emerging, particularly out of US, the way the trade negotiations are happening. I think each day we hear some or the other tariff that is being implemented on countries. Our view there is that the US president has won the election on a bid to say that we will ensure that trade deficit goes down and tariffs will be a tool to ensure that that happens. Plus, it's also a tool to deal with negotiations as far as partner countries are concerned. What that is doing is the fact that as this gets rolled out and there is no certainty as far as the current situation is concerned as to which country, which commodity will see application of tariffs, there is this to and fro and volatility that keeps happening based on the news flow which emanates from the White House and statements that come from the US. So that is creating a degree of uncertainty. Our expectation there is over the course of the next 3 to 4 months, we will probably see that settling down, because even if the tariffs are implemented, at least that provides a situation to businesses to take decisions. What is happening at this point of time is because there is to and fro on the tariffs and the quantum of tariffs, it's extremely difficult to figure out measures which the companies need to take to adapt to the new environment of working globally. So that has increased the uncertainty that is there as far as the export side of the demand is concerned. A second fallout of that, which is an indirect fallout, is the fact that whenever tariffs get implemented, obviously goods will become expensive as far as US is concerned, which in turn means that the rate cut cycle, which was anticipated to follow through in this entire calendar year, the quantum of rate cut, particularly from US, has now become more data dependent. We'll have to wait to see the incoming data to decide how many rate cuts will actually eventually flow out, because these tariffs will, in the very short and near term, mean that things get inflationary as far as the US economy is concerned. That in turn has meant that outflows have continued, because the 10-year US GSEC yield shot up all the way to 4.8%. Right now, it's trading closer to 4.15 to 4.2%. But there has been an increase in volatility as far as the US GSEC is also concerned. Coming to the outlook, our sense is that given India's trade with the US, so US accounts for close to 17% of India's exports, we believe that there will be an imposition of some form or the other reciprocal tariff that will happen on partner countries, India also being a partner country. We have been hearing tariffs across certain sectors where India exports. I think India is reaching out to the US to figure out a best possible solution in the current situation that is there, but there will be certain segments where India exports to US which may face a reciprocal tariff. On the contrary, on the reverse side, what will work out is the fact that other partner countries which run a larger trade deficit with US may see a higher tariff getting imposed as far as their exports are concerned, which relatively should put India in a better situation. Having said that, the clear US anti-China stance, we've actually seen a 20% tariff being already put on goods that are being exported from China to India, while we still await clarity on what happens to exports from India. But what that clearly means is that certain sectors will relatively start to benefit, be it electronics, pharmaceutical, textile, refining, and others, where the fact that US will remain more anti-China compared to rest of the world will mean that relatively India should be better off in these particular pockets. But in the near term, we have to deal with the heightened volatility that we are witnessing, particularly around the tariff news flow. This will in turn also mean that certain sectors can open up where partnerships can get strengthened with US companies, particularly electronics, IT, hardware, tech, energy, which is a large export as far as US is concerned. Pharmaceuticals will be a relative game, so will home textiles, where essentially tariffs will be applied both on India and China, but relatively we should be better off compared to the tariffs that will be implemented on China. So the hope is certain sectors will benefit out of this upheaval that we are witnessing in the global supply chain. And the endeavor of the government here is also to ensure that the negatives of the tariff are limited as far as the impact is concerned, while we are able to harness the maximum benefit that will play out from a new global supply chain. Sectors where we are significantly exposed to US, pharma clearly stands out. That is a big export as far as India is concerned to US. It accounts for 40 to 50%. So India accounts for 40 to 50% of supplies to US. An implementation of tariff on pharmaceutical will essentially mean that prices in US will go up. So I think the US administration will also look to ensure that while yes, tariffs are implemented, there are certain essential drugs on which prices start to go up that in turn impacts the purchasing power ability of the citizens in US and the insurers. So the hope is that while yes, tariffs can get implemented, but it's difficult to substitute Indian supplies given the cost at which we supply. So relatively, while on the whole it may be negative, but relatively India should benefit even if tariffs are implemented, because competition out of into US in pharmaceutical other than India is China. As far as the silver lining in the budget is concerned, so there were two or three key takeaways from the budget. This budget was clearly focused on consumption, consolidation, and capex. Starting with the first item, which is capex, where there was an expectation that capex may be cut. On the contrary, we saw a figure of 11.2 trillion, which is a growth of 10% compared to the actual estimated spend for FY25. While this is exactly the same number as that was put out in the budget of FY25, so that remains unchanged. So while capex spend has been lower in this year, we will see a 10% growth compared to that on the capex. As far as the fiscal deficit is concerned, the government has ensured that they move towards the target of consolidation. So the fiscal deficit target of 4.4% opens up an elbow room for the RBI to loosen monetary policy to support growth. We saw one action, which was a 25 basis point rate cut immediately after the budget. Our sense is as we see more room that is available as far as the monetary space is concerned, we will see monetary actions happening, We are already seeing a lot of OMO actions happening from the RBI over the course of the last 2 months in particular, with change of guard at the RBI, which means that there is liquidity that is being infused into the system to support growth. On consumption, clearly there was a growing demand for a tax cut. I think government has followed through, ensuring that a large part of the population now comes into the no tax zone, with the slab being increased to 12 lakh. On an aggregate level, this essentially means 1 trillion rupees of lower tax payment by the people who are already paying taxes. Our expectation is a part of that will go into savings, a part of that will get pushed into consumption. But as far as the impact of this is concerned, our expectation is that it will be probably towards the middle of the second quarter or closer to festive. As from April, people will start to see the benefit of lower taxation as far as salary in hand is concerned. That in turn will mean that they will take some time to figure out that this is a more structural move. This is not a one-time benefit, which in turn should start improving consumption. So the expectation is, and based on the commentaries that we've been hearing, particularly from companies, rural clearly is holding out, and there is an improvement as far as consumption spent from rural is concerned. Urban is what is dragging, and that remains a major source of the sluggishness in consumption demand. Tax cut clearly impacts more the formal sector, which in turn means that this sluggish urban demand should start to improve. Our expectation is it will take a quarter and a half before we actually start to see improvement as far as consumption is concerned. When we look at the year in retrospect, 2024, clearly it was a year where we were faced with certain large events, the biggest one being the election that panned out in that year. Second big event that happened was particularly in the neighborhood, which is the Bangladesh crisis. And the third big event was we saw record money raising from the Indian equity market. When we look at the year in retrospect and the entire year, what we saw was there was an upfronting of returns at the beginning of the year. There was an expectation that earnings growth will start to accelerate from festive. While on the contrary, what played out was that there was a significant slowdown as far as consumption is concerned, particularly in the post-festive period, which was to a large extent to do with the climatic conditions that were not favorable in Kharif, while there was sufficient rainfall that happened, but the spatial distribution was not adequate. Also, the timing of the monsoon was not great, which meant that the Kharif season suffered, while the Rabi crop is holding out good because of the water reservoir level, and the expectation is that we start to see recovery in demand. Most of the commentary points towards that the rural recovery in demand, particularly on consumption, has started to happen. There were certain sectors which did well in 2024, be it energy transition, the entire circular economy space, the electronic manufacturing space, particularly the likes of the PCBA manufacturers and the likes of Dixon, who are essentially outsourced manufacturers for electronics. We also saw new age tech and hospitality. These two sectors continuing to do well. Hospitality continued to be supported by higher room rates, which in turn meant that profitability remained intact, and we saw growth in this sector even as consumption was slowing down. When we look at the global market performance, one thing clearly stands out is the fact that last year in particular, as we've mentioned, that because there was an adjustment which happened where earnings growth were revised downwards, we've actually seen a flattish year as far as 1 year return is concerned for the Indian markets. While certain markets where there was significant amount of negativity built in, particularly the European markets and the Chinese markets, they performed well given the fact that there wasn't an immediate implication as far as the tariffs were concerned. So there was an initial talk about first day 60% tariff to be hit at China. We've only seen 20% tariffs being implemented. So that meant that contrary to expectation, there was a lower outcome as far as the tariffs are concerned. While still very early days, we need to see how the administration behaves going forward. From an Europe perspective, clearly with the elections out of the way in Germany, there is a realization that there will be loosening of the fiscal deficit there, and you will actually see spending starting to increase, particularly in the first leg focused on defense, which remains in need of the hour, followed by spending on infrastructure, which also needs significant amount of spending. So I think that has supported the German market in particular. Coupled with that, I think the Chinese market, currently, given the news flow that has come, that they are targeting a higher fiscal deficit for this calendar year, clearly means that there is a realization that growth needs to be supported in China, which in turn has also meant that that market has performed well. For CYTD, as far as the current year is concerned, we've actually seen India remain particularly under pressure. That comes on the back of stellar performance in the last 2-3 years in particular. So we are actually seeing an adjustment that is happening as far as the Indian market is concerned. Markets across the board have corrected in this calendar year so far, particularly from their 52-week high. India remains somewhere in the middle as far as that correction is concerned. Coming to currency movements, I think this has been another factor which in turn is linked with what is happening on the US GSEC rate, which has essentially gone up. This has meant that currencies have depreciated compared to the USD. Our currency, after seeing a very low period of volatility, has actually corrected by close to 5.5%. So there is a depreciation. Last 3 months, we've actually seen a 3.5% kind of depreciation. While this is in line with the more long-term trend of currency depreciation, which generally is 3 to 4%, we had actually seen 1 year of very stable currency rates, and we are now seeing an impact particularly accentuated by the way flows are behaving. The biggest commodity as far as our imports are concerned, which is oil, that continues to remain range-bound and continues to head lower. This will have a push and pull as always. The push particularly is driven by the fact that there is slowdown in global demand. If that slowdown continues, that means demand of oil continues to go down, and that increases the relative gap between supply and demand. While on the supply side, if we see any knee-jerk actions on the supply side, that is where it gets supported as far as the gap between demand and supply is concerned. As things stand right now, there is a clear focus of US also looking to export energy out of their country. If there is some stabilization in Middle East, that will essentially mean that supplies will be higher, which in turn should ensure that crude oil continues to remain in a range, which should support our current account deficit. Coming to flows, which has been a big negative as far as this particular calendar year is concerned. So we've actually seen large flows from October 2024 till now. We've seen close to 25 billion kind of outflows as far as the Indian market is concerned. Taiwan is the next close competitor as far as from where the outflows have happened, which is 11 billion. So we continue to see FII money being pulled out of the system. Most of that is to do with the differential as far as the return differential between the Indian market and the US market is concerned, coupled with the currency volatility that the FIIs have to deal with when they are investing outside of the US market in any other emerging market. So flows continue to remain negative as far as FIIs are concerned. These have been supported largely by the domestic side. We've actually seen domestic flows hold out, which in turn has meant a lot of this supply has got absorbed from the DIIs, which in turn is nothing but the retail investment as far as the equity market is concerned. We've also seen these flows support the kind of supply that hit the market in CY24 from a fundraise perspective. So this has taken care of both fundraise and the FII outflow. We are now starting to see the heavyweight of a combination of FII outflow playing out as far as this calendar year is concerned, where we've started to see indices correct. When we look at the performance of the market from a market cap perspective, clearly what we are witnessing is starting from Q3 of FY25, where we saw first bout of correction happen, where mid caps and small caps corrected by 6% and 3%, while the headline index also corrected by 8%. In Q4, which is calendar year till now, particularly 28th Feb, we've actually seen an accentuated decline as far as mid caps and small caps are concerned relative to the larger cap, which is the Nifty 50. It obviously comes on the backdrop of stellar 2 years of performance as far as the mid cap and small caps were concerned. We are now starting to see some amount of reversion to mean. This has got accentuated because of technical liquidity factors. So our sense here is that once this period of volatility settles down, you will actually see businesses that continue to perform and deliver on earnings growth find their feet and start to perform and deliver returns. While there will be names where the elevated expectations are not met, those names will continue to decline and probably continue to underperform from a more medium to long-term perspective. So we are currently going through a phase of a readjustment. In the first leg of these phases, typically you see selling which happens across the board. That is what we are witnessing at this point of time. As the year continues to roll forward and we continue to see the earnings imprint that start to come through, you will actually see a segregation of performance. And this will be a year of stock selection in particular as far as return is concerned. The intensity of the fall also has been greater. When you look at the mid cap and small cap, we've actually seen a sharper correction in mid cap and small cap. This is what this table tries to bring to light. So if you look at the mid cap and small cap, where there has been more than 20% fall, that together accounts for close to 81%, while the large cap, number is closer to 20%. So we're actually seeing a higher degree of fall in mid caps and small caps. That is also to do with the fact that liquidity in these names is typically lower than large cap, which means that if there is an accelerated selling that happens, typically you see a higher fall, and vice versa. Even when things are good, you see this getting propped up in the other direction. Coming to valuations starting when we were sitting probably closer to the election outcome, which was June, after a brief period of volatility, we actually saw indices perform well with an expectation that you will actually start to see recovery in earnings growth. As the year has progressed, we've actually seen earnings number get revised lower. Coupled with that, a fall in the market also has meant that valuations too have now moved below the 10-year average as far as the Nifty is concerned. So valuations are below mean of the last 10 years as far as the overall index valuation is concerned. Coming to our portfolio company performance, I think this clearly shows that the earnings delivery of the portfolio continues to remain superior. We've actually seen a 23% operating profit growth for the portfolio as a whole. In the third quarter, PAT growth has been upwards of 25%. It's 27% in this period. For this entire fiscal, we are actually seeing a divergence that is starting to open up as far as earnings delivery is concerned between the portfolio and the benchmark. Our expectation is that this divergence in earnings will eventually play out in divergence in returns. We actually saw a brief period of that play out between the period of July to December, when we saw our portfolio perform better compared to the benchmark and outperform. While what has hit us in the last 2 months is not a significant negative earnings growth environment, while our portfolio is delivered at an overall level of upwards of 20%, barring 2 or 3 names, we actually saw most of the names deliver in line or tad bit better than the earnings expectation that we had from our portfolio companies. We are currently essentially dealing with a situation where higher volatility is impacting performance. So our expectation is that if these earnings delivery happen as they've been happening, and the divergence in earnings will mean that you will start to see outperformance as far as this portfolio is concerned, once this entire period of volatility settles down. The way we are looking at this period settling down is, from an earnings perspective, our expectation is for FY26, the earnings growth delivery will be back-ended, which essentially means that you will see delivery improve, particularly from the second half or second quarter of FY26 through second half of FY26. That is what we expect will play out. That will have a combination of effects. One is government starting to spend. So actually last year you had first 4 months where there was spend that was impacted, particularly because of elections. That is not the case this year. So we'll actually see government spend continuing. The second bit of the equation is consumption, where we expect that consumption should start to accelerate, starting anywhere close to the end of first quarter or somewhere in the middle of second quarter. FY26 has a festive period, which is again preponed. So you have festive period that is in the early part of the year and completes by the first half of October of 25, which is FY26. So you have an early festive this year, which will mean that somewhere in Q2, you start to see demand recovery happens as the channel fills up for the festive period. The only caution over here remains how the climate will play out. We are already witnessing a high degree of heat. If we don't see any negative surprise as far as monsoons are concerned, our sense is rural recovery, which has started to gain momentum in Q3, that will continue to follow through in FY26, while urban demand, which has been sluggish, starts to come and deliver in the second half of FY26. Exports, our assessment is that they will still remain volatile. in the near term as this entire tariff bit settles down. Once there is a settling down of tariffs and everyone knows how to operate in the new environment and the new rates of tariffs, our expectation is that growth will start to pick up. From an export market perspective, given that Europe growth is sluggish, we expect European demand recovery also to be sluggish. So companies and sectors which are more exposed to the European region will probably see a slower rate of recovery. As far as exports to other parts of the world is concerned, we actually expect exports will continue to pick up steam. Particularly from a US perspective, our sense is that once we have more clarity in the next 3 to 4 months, we will actually see exports start to contribute. So exports also in a way start to contribute only from the second half onward. So this will be a year where first half you will still continue to see earnings which are sluggish in a period of higher noise and news flow, which will mean that volatility will continue to remain high. If the FIA outflow continues, that will mean that the liquidity issues will also continue, which in turn will again mean that the period of volatility in the near term will remain high. While as earnings start to recover from the second half and you see semblance on the outflow and the liquidity front, you will start to see select stocks and sectors continuing to do well, which are structurally well poised for growth. When we look at our actions, we've essentially rejigged the portfolio to sectors and pockets which we believe from a medium to long term should benefit, while in the near term there will be higher volatility. We continue to believe that manufacturing as a theme from a more medium to long term perspective will continue to do well. When we look at our weights for the infra and engineering space, we've actually increased weights from 31% in June of 24 to 37% as of Feb. The weight switch is largely from consumption to infra and engineering. Within infra and engineering, it is specifically capital goods. There were certain names where we were looking for correction in valuations to enter, where we felt that the medium to long-term story of growth continues to remain intact, but we were not happy with the valuations where they were. We were looking for a better entry point. So we started making those entries into those particular names and stocks. So the likes of Musgow, Dock, Keynes, Amber, these are some of the names where we've started to build positions. The expectation is that over medium to long term, you will see electronics as a space, outsourced manufacturing as a space continuing to do well. Defense, our expectation is continues to do well in light of what we are witnessing from a more geopolitical front. The other sector where we still continue to expect government capex to remain high is energy and utilities, because this is a pocket which is faced with two themes together. One is increased domestic demand as far as the energy requirement is concerned. Second is the need to upgrade the entire T&D capex that is there in the country and the infrastructure that exists today to incorporate the shift that we are witnessing from input or change in input of electricity into the grid system. So we are actually seeing renewables continue to add more, which in turn means that the grids need to be adjusted to deal with more electricity flow from the renewable sector. So we are actually expecting that this pocket continues to benefit from government capex. The entire infra and engineering, including capital goods, continues to do well with the policies that are in place and the shift as far as the global supply chain is concerned. Healthcare, we've held on to the weights because we believe that pocket provides an opportunity both in terms of medical devices, pharmaceuticals. Both these sectors should do well. Even the healthcare providers should do well in this particular pocket. Coming to the valuation and how we see the entire psychography for the portfolio. So for this year, FY25, we expect EPS growth of 23%. For FY26, we expect this to increase to 29% as far as the EPS growth is concerned, with acceleration that we anticipate. ROCs continue to remain upwards of 30%. So quality of growth will also improve in FY26 with acceleration in earnings growth. Given the fact that we witnessed a fair degree of correction as far as valuations are concerned, which is summarized in this particular chart. So over the course of the last 4 years, we've actually seen valuations drop from closer to 42 years forward to 27. Our expectation is that with delivery of earnings, the quality improving for the portfolio as a whole, and the divergence in performance of the earnings for the portfolio compared to the benchmark, we should see outperformance as compared to the benchmark open up. What we are waiting for clearly is a settlement period of volatility in this particular period, particularly driven by the news flow from the US. and a recovery in consumption, where we believe the government has taken adequate steps, but we will have to wait for the response that happens of those steps as far as revival in consumption is concerned. So with that, I will stop the presentation here and I'll open the floor for question and answers.
Thanks, Chetan. I would request participants to type in your questions and queries related to the portfolio, and we shall curate and try to get them answered. Participant can type their questions and queries related to the portfolio, and we shall curate and try to get them answered. Chetan, there is a lot of interest building up with multiple questions already been raised during the call. Uh, the first question is that markets are witnessing lots of volatility due to global factors like tariff disruption created by US. How would these tariff decisions impact EOP portfolio companies?
So when we look at the portfolio and where the tariffs can come, so when we look at the exports from India to US, clearly one pocket which can get impacted is pharmaceuticals. That is a pocket where essentially there can be reciprocal tariffs that happen. The exposure that we have in the portfolio today to that space is more to do with names which are more domestic focused as compared to US focused. So we have a Mankind in the portfolio. We have the likes of Polymedicure in the portfolio, which again is more to do with the shift of medical device consumption in the country and exports are to a large extent to Europe. So which means that the portfolio and a pocket where we expect a larger reciprocal tariff that remains to a certain extent shielded because of what we are seeing in US, because the exposure to US there remains low. Certain pockets, such as particularly auto ancillary in the portfolio, where you have a fair degree of exposure to either directly US or through the route of Mexico into US. There, our expectation is that there has been a lot of dates that have come and gone, where the president first announces a tariff to begin at a certain date, then there are certain exemptions which kick in. Our sense there is that even if on the entire auto ancillary space, if there is a tariff which gets hit to Mexico and Canada, it is very difficult to set up that entire supply chain in US. So that will take probably 3 to 4 years by the time the shift in supply chain happens. In the meantime, it will mean that goods start to move into US at higher cost, which in turn will mean that cost to consumers in US go up. So our sense is, yes, there is a lot of noise at this point of time, but given what we are also witnessing in terms of news flow coming in and moving out, there is some degree of realism that is kicking in, that there will be certain sectors where it's difficult to change supply chains, and in the near term that can mean higher cost to US consumers. In certain cases, this near term can be a year and a half, but for the things which are more capex heavy, this will actually mean a longer period of gestation before supply chains start to move. So those pockets are senses they might get exemptions. You will see lower tariffs getting implemented there. The worst case situation is that you actually see a tariff that gets implemented to those pockets, but there is no alternate route that is available, which in turn will mean that there will be higher cost that gets passed on to the consumers, which can eventually have an impact on demand, clearly. But it is still there is still too much noise into the system to eventually figure out what will be the impact. But clearly, relatively, the portfolio is better placed as far as the export to US is concerned.
Okay, the next question is that what are the key themes which you are covering currently in the UPEOF strategy?
So, like I highlighted, we still continue to remain very much bullish on the entire manufacturing space, the infra and engineering space in particular. Our sense is, with the measures that the government has taken over a period of time, be it the PLI, be it the tariff, non-tariff barriers that have been implemented, the clear focus is to manufacture it in India and for the globe from India. Clearly, we are seeing a shift as far as supply chains are concerned, given that this is a sector which typically takes a fair degree of time before the entire ecosystem sets in. The growth rate, while can remain higher for longer, the initial period or gestation period for all the pieces of the supply chain to come together takes its own time. What we are witnessing at this point of time is a lot of those pieces are in place. We are actually seeing a fair degree of growth come to that pocket, be it the likes of Dixon, be it the likes of Amber, Keynes, which are all outsourced manufacturers. We are actually seeing that play out. In terms of segments, be it mobile phone assembly, we've actually seen a great success there. We are now seeing backward integration that is happening into the entire ecosystem, where there is a clear push to manufacture PCBs also now here, not only do assembly. People are committing capex for display chips as well, which is again a large part of the BOM. So what is playing out clearly is the first leg, which was the easy leg, which was moving assembly, that has happened. The difficult leg, which is now starting to move backwards and get all the components also manufactured in India, that has also started to play out. And there is a clear focus from technology providers to tie up with Indian entities which have the balance sheet and the strength to go ahead and commit such capexes. And there is a fair degree of support from the government, both in terms of capex subsidies that are being offered by the central government, additional OPEX subsidies that are being offered by both center and states. There is a very good positive competition that is happening at this point of time between states to ensure all of them attract a fair degree of investment. While in the near term, there will be volatility because of the news flow that is happening. Structurally, we are very confident that this segment will do well and this pocket will do well, both in terms of earnings delivery and the fact that there is clearly a shift of global supply chain from where there is a clear government focus to come out on top of this adverse event rather than trying to defensively protect this current situation. So our focus remains on increasing weight there. We are now comfortable with the weight that we have in that particular sector. There are still certain names where we've taken entry, where we would like to increase positions. We are probably adding some bit of positions at this point of time and waiting and watching to see if the volatility provides a better entry point into those names. The second bit is again a larger manufacturing, be it auto ancillary, be it pharmaceutical, or the entire healthcare exposure that we have in the portfolio, which we believe will continue to do well. Utilities and power, like I mentioned, is more domestic driven, where we believe that that is need of the hour to set up both generation capacity and transmission and distribution capacities as well. So we are essentially seeing a lot of capex happen there. So that space will continue to do well because of the base demand that we are witnessing in that particular sector. A consumption discretionary. So consumption has to be broken down into two parts. Staples is clearly witnessing weakness because of volume growth that is happening, which has come in very low single digits. Our sense is even if incomes improve, given the higher penetration in these categories, it is discretionary, which will start to do well. There was a fair degree of earnings growth expectation that was built into the discretionary names, which meant that valuations were on the higher side. What we are witnessing is there has been a fair degree of correction as far as one, those expectations are concerned and valuations in that particular part of the market. We are looking at opportunities where we want to increase weight, particularly on the consumption discretionary side. Similarly, on financials, our sense is we right now have just an NBFC exposure in the portfolio. Clearly, what we now expect is a more shallow rate cut cycle. So we are also looking at banking as a space which we felt 4 months back that this will be a pocket which will struggle for earnings growth, where earnings growth will be lower than loan growth. There was an issue of non-performing loans, particularly on the unsecured side. We've seen a lot of measures come in by the regulator, and there is a fair degree of adjustment that is happening as far as those portfolios are concerned. So clearly, looking a year and two ahead, there is an opportunity there as well where we might increase weight. So at this point of time, we've taken fair degree of exposure in pocket that we liked from a medium to long-term perspective. There is still some rejigging that we will do in the portfolio towards sectors which we still believe can outperform. So at an opportune time, you will see that amount of drift as well from the portfolio.
Okay, Chetan, we have increased weight significantly in recent time in capital goods to 26% now. In recent times, this segment has fallen sharply from its peak. How do you see the valuation in this segment, especially APL Apollo Tubes, Jupiter Wagons, dragging the portfolio performance?
So this was a space where there was a fair amount of optimism built in, both in terms of earnings delivery and that got captured in higher valuations for the space. So while we liked a lot of businesses in this particular space, we were looking for corrections to enter. That is what we've started to do now, where valuations have started to go down. We've started to build positions gradually in that particular pocket. For names that we already own, particularly the likes of APL Apollo, which has been a long-term holding for us, that space actually got impacted not more from volume growth, but that got more impacted from how spreads have behaved, particularly on the steel side, where we've actually seen a downward pressure on spreads, given how China was exporting and the situation in China, particularly on the economic growth front, which meant that they were exporting more as domestic consumption there was impacted. What we are starting to see is the fact that as China loosens its fiscal deficit, that will mean that domestic demand in China starts to move up. So not only in steel, but across a lot of these sectors where there was a fair degree of higher pricing pressure from China, our sense is as demand in China recovers, you will actually see spreads recovering in those businesses. So while volume growth continues to remain robust for the entire space, we've actually seen a good 7-8% increase in consumption demand for steel. This is again a part of that segment where we've actually seen volume growth remain closer to 15%. There was some impact on volumes because of the capex spent by the government, particularly given that first 4 months went in the election and the new government coming in place or the new cabinet coming in place. Our sense is for FY26 that is now behind us. We've actually seen acceleration of capex, particularly from October, November onwards. So our expectation is that continues through FY26 and the remainder time of the tenure of this government, which in turn will support volumes, and with spreads getting support, I think that name should do well both in terms of earnings, and we've actually seen compression in valuations. So that means there should be an outperformance that opens up. Coming to Jupiter, I think what has happened in Jupiter is one is clearly the fact that there has been a slight miss as far as earnings expectation that were built in and that have got delivered is concerned. That is to do with the fact that there has been some shifting of or postponement of demand from the government, which remains a single buyer. Order books continue to remain robust. So delivery of those order book itself takes care of FY26 earnings growth for such names. Mid caps and small caps in general have also gotten impacted by the way liquidity is playing out. So that essentially means that while earnings may not have changed too much, a selling pressure by any one particular entity who wants to exit, given that liquidity has fallen, will mean that there will be a larger impact on stock price as compared to the impact on business that has happened in terms of earnings. So our sense is near term, this pocket will still see volatility given how liquidity is playing out. While more medium to long term, our sense is the delivery of earnings will mean that there is recovery here. So this pack as a whole, our expectation is that so the last 2 years have essentially been years where anyone who had allocated to this pocket did very well, irrespective of stock selection, because there was a lot of money that was chasing this particular part of the market. As we look ahead after this shakedown, the expectation is this market will become very stock specific. Companies which deliver on earnings will do well as far as returns are concerned from here on. Companies which don't meet the expectation of earnings growth will actually continue to face a fair degree of pressure. So this market going ahead has become more of a stock selection market, which is a market where you can actually generate a fair degree of alpha by getting the selection right. While last 2 years was a market of allocation, where anyone who had allocated to this part of the market did well, because when you look at the divergence that has been there on return delivery of large cap to mid cap, there is a large divergence that has happened in the performance of the mid caps and large caps. So our sense is there is convergence that is happening now. Large caps are falling less, mid caps, small caps are falling more. Eventually, irrespective of market cap, our sense is businesses which deliver an expectation of earnings, given where valuations are, should incrementally start to outperform from a more medium to long term perspective. While that will play out in the course of the next 1 year, 2 year, in the very near term, we still expect volatility to remain high because of all the factors put together, how they are playing out.
Yeah, just your second half of your part of the answer. There's a question related to that because the portfolio has got more allocation to small mid caps and around 30% in large cap. Looking into the current scenario, are you looking at altering the market cap mix of EOP towards large cap?
No, so I think what we continue to focus on is quality of businesses that we buy in the portfolio. And clearly, market cap is obviously a part of that. The endeavor here is to be more tilted towards mid caps and small caps. The focus remains there to continue to build positions there. We will try and balance what we need to do. But the first bit of the filter is delivery of earnings. Can a company meet our criteria and can they deliver the earnings? Particularly given the environment in which we are, markets will be very harsh with names where the delivery cannot happen of earnings and valuations remain high. So we are cognizant of that. So we are essentially looking at names even after this correction where there is a higher degree of confidence on delivery of earnings. So there will be no knee-jerk adjustment that happens purely based on market cap. The adjustments will be on the merit of the names that are getting in and getting out of the portfolio.
Okay. The next question is, when markets were going up, EOP and EOF were underperforming and did not went up beyond benchmark. Now, when markets are falling, EOP has fallen more. Investors were expecting better performance to cover underperformance of last few years. EOF 1 and 2 investors XIR is around 7-8%. What can investor expect over a period of next 2 to 3 years?
So here very clearly, Ravinder, like I mentioned early on, we had actually seen, so there was first part where we saw convergence of earnings of benchmark to our portfolio. That meant that the benchmark, which was at a lower valuation, played a catch up as far as our portfolio is concerned. And to play the catch up, that meant that the benchmark outperformed the portfolio. There has again been a divergence in the earnings delivery. Our portfolio earnings have been superior in terms of delivery compared to the benchmark. We expect that to be the case in both FY26 and 27. We had started to see first glimpse of that when I look at the performance between July to December. We had actually, when this divergence opened up as far as earnings delivery of the portfolio and the benchmark is concerned, we saw this portfolio outperform the benchmark in that particular period. The last 2 months have actually been a period of, irrespective of delivery of earnings, because of the liquidity factors that are playing out. We've seen names even where earnings delivery has been good. They've also taken a beating primarily just because of the way markets are behaving and how liquidity is behaving in the system. Our sense is that flows again are something which are macro driven, which are not under our control. We are cognizant of the fact that this will mean that we will have to deal with higher volatility in the near term because of how flows and liquidity play out. If we remain confident of earnings delivery of the portfolio and keep rejigging the portfolio to ensure that that superiority of both quality and quality of growth remains intact, you will see that divergence in return delivery as well. So far we've actually seen 7-8% kind of IRR. Our expectation is with this correction, the implied return of the portfolio has actually gone up. So relatively, we should start to see acceleration as far as returns are concerned. Difficult to time it. Logically speaking, our sense is it should coincide with when we see acceleration in earnings. There, the expectation is that you will see acceleration in earnings starting somewhere from the beginning or mid of Q2 of FY26. And that is where our sense is that a lot of this news flow driven volatility will also get arrested. There will be some degree of stability because we will know what are the tariffs, which sectors get impacted, and businesses also will know how to respond. The challenge at this point of time is that given the volatility that we are witnessing driven by news flow, it's very difficult for anyone who's running a business to take any decisions, which in turn means that. So if I look at IT in particular, where decision making and budgeting typically happens from a customer perspective in January and February, what we are picking up is there has been delay in decision making because people are not too sure of how tariffs will play out, which in turn they are not too sure of how their customers will behave. So a very natural way to respond to such a situation is to wait it out, which in turn means that if decision making gets delayed, you actually see postponement and pushing ahead of what was expected in terms of delivery. So today we are dealing with a situation where people are still waiting for clarity to start making decisions. So our expectation is that as this settles down, volatility settles down, earnings growth start to recover, valuations have gotten to a certain extent comfortable. If this volatility continues, they get more comfortable. So then you start to see returns accelerating. So when I look at these 2 years in particular, so FY25, first half, there was an expectation that the benchmark will do 15-16% kind of earnings growth. So what we saw was a preponement of returns on the benchmark, that there was a fair degree of expectation that earnings acceleration will be there. While the large caps were expected to deliver 15-16% earnings growth, probably mid caps and small caps were expected to deliver upwards of 20% earnings growth. What played out over the course of the year was large caps are settling somewhere between 5 to 6% kind of earnings growth. There has been a downward revision as far as mid caps and small caps are concerned. So we are also seeing markets correct in the similar manner to adjust to the reality of earnings growth of FY25 and to a certain extent cuts that have happened to FY26 as well. So our expectation is that as earnings recovery happens and you are invested in right pockets, right stocks, where this delivery continues, you will see returns that start to get accelerated, and that gap again opens up, which we had witnessed briefly in the course of July to December.
Okay, the next question is regarding KEI Industries stock. There is a significant correction in KEI Industries post announcement by Aditya Birla Group for entry into this segment. What's your views about this disruption, which would be caused by Ultratech next year?
So I think Ultratech, what they've announced is when we look at the industry size is closer to 70,000 odd crore. It's growing at upwards of 10% at an industry level, anywhere between 10 to 12%. That means that by the time Ultratech gets into the industry with the plants being on ground and supply starting, this will be an industry which is close to 80 to 90,000 odd crores. Out of which the capex that they've committed, which is 1,800 crore with a peak revenue expectation of 7,000 crore, will mean that they get an incremental 7-8% share out of the entire industry. Logically speaking, this share should go out from the unorganized sector, but there is obviously an impact of what has happened in the paints playing out in the minds of investors today, which means that with increased competitive intensity, you might see margins go down, and which in turn will impact ROC, and which in turn can impact valuations. As far as we are concerned, we are watching it very closely. We've seen first leg of that negative impact of expectation getting built in, that you see a shaving off of margin that happens to the extent of 20% compared to where they are today. While in the near term, we don't see earnings being a concern. Earnings will get delivered. We will need to see the intensity with which Ultratech comes into the picture. On the call, what they mentioned was when someone asked them, where will you target the margins or what are the margins that are targeted by Ultratech? They said that we are targeting an industry average margin. So very difficult to say till we know what is their GTM. In the first leg, we've seen a knee-jerk reaction where people have tried to say that what has happened in the paints industry again gets replicated in the wires and cable industry. And that is where they've adjusted the margins to say that this can be a lower ROC business compared to what we've been used to, particularly in the last 2 years. When we look at the industry structure, clearly the guys who are more focused on wires are to that extent insulated because it's more B2C compared to the cable side, which is more B2B to that extent. A way to net this off is anyone who is also exposed on exports, which is where even KEI is exposed. They get to play the export opportunity as far as cables are concerned. As far as the domestic bit is concerned, there might be an increase in competitive intensity, but our sense is a lot of that has got adjusted in the first leg. We will keep a very close eye. We continue to monitor what Ultratech is doing, particularly by way of their go-to-market whenever they are closer to launch. So for them, they've said that it'll take 2 years for the plant to come up. So you won't see an impact playing out in the marketplace before FY27 end or in FY28. So we are keeping a close eye there. While near term, we don't expect earnings to get impacted. Clearly, there is a fear that the ROC of these businesses get impacted, which in turn has meant that valuations have corrected. So we are keeping a close eye there. If we don't see a very large negative impact on the industry structure and Ultratech comes out and operates at industry average margins, then I think there will be again re-rating that happens. But clearly the narrative in the near term has turned a tad bit negative compared to what we were seeing 2 months back before this announcement, where everything was going right, be in terms of capex at the domestic level, what we are witnessing, particularly from the key export market, where there is an upgradation of the entire T&D system, which means cable demand remains high, supply was limited. So I think the narrative has got impacted a bit, but we are keeping a close eye there.
Okay, the next question is regarding PI Industries. It's been long that PI Industries is underperforming. This quarterly results of PI PAT was down 17%. Your views on this?
So I think PI is also facing what we were seeing in other pockets, particularly on the AgChem side. So their CSM business, where one product reliance is higher, which again is exposed to how global cycles play out. So we've actually seen that product continue to do well even while the global AgChem cycle had turned adverse. What we are witnessing at this point of time is some degree of adjustment that is happening as far as that piece of their business is concerned, and we are starting to see some amount of impact there. When we look at the commentary that is coming out from most of the global AgChem MNC players, clearly it looks like things are bottoming out there and things should start to recover after a period of good 1.5 year of destocking and adjustment of inventory. When we look at PI clearly has two components from a more medium to long term perspective. While AgChem has delivered what they need to deliver, you will still see growth that comes on the AgChem side. For them to actually deliver in terms of the expectation, it's more on the pharma side. The acquisitions that they've made there, pharma typically is a more longer gestation business to begin with. So our sense is the strength of the business continues to remain intact, be it the chemistry capability, their ability to attract customers, their hold on process chemistry. So all of them clearly stands out. While in the near term, we deal with the fact that there is some adjustment that is happening, which is belated in case of PI from their customer perspective, but things are bottoming out there. So we are actually seeing valuations there correct, given that earnings have been missed compared to what was earlier expected of FY25. But the underlying is bottoming out largely. So we still continue to hold to that name. We've trimmed positions at higher levels, but we continue to like that name in the entire chemical exposure as far as the portfolio is concerned. So that is probably one of the few names where we still continue to have a chemical exposure to play the theme of the export driven opportunity for this particular sector.
Uh, there's a lot of underperformance in Keynes Technology India Limited. It has fallen around 40-45% in calendar year 25. Your views on that?
So while from a sector perspective, we believe the opportunity remains fairly large and it's growing at a significantly rapid rate at an industry level itself. So it's again a 60-70,000 crore market. If you put all appliances put together and look at the PCBA opportunity, that's close to 1.2 trillion. When we look at the leading names that are there and particularly the listed names, today and the expectation of what they can do in FY27, they will still together account for 40-50%. So clearly the room remains large as consumer durables continue to grow faster with increase in discretionary spend. This opportunity keeps getting better. Our sense is as these businesses mature, they will also go through the cycle, which in turn will mean that they started with PCBA, which was assembly. They will all start to backward integrate, move into PCB. We've seen one announcement by Amber that has followed through. We see the OSAT announcement by Keynes. So clearly the focus will remain on moving backwards. Growth remains high, while ROC for these businesses remain capped closer to 18 to 20%. The runway for growth is significantly longer. So our sense is given how this business operates typically quarter to quarter, there can be higher volatility as far as earnings delivery is concerned, but structurally they'll continue to move in the right direction. This correction in valuation actually provides an opportunity to build some positions there, and that is what we are looking to do. Because we liked this space, what we were not comfortable was with the valuations. So we've started to gradually build positions there. We are bullish on this entire space. Clearly, the correction in valuation provides an opportunity, maybe with this increased volatility that gets a bit more sweeter as compared to where we are. So the aim will ideally be to gradually keep increasing exposure in this space.
Uh, any investor who wants to enter into UP today, how should he allocate the money in a staggered manner or lump sum?
We still think that the inflow should be more staggered because we still near term expect a fair degree of volatility as far as the market in general is concerned. Particularly, the volatility can remain higher when we look at what is playing out in the near term in the mid caps and small caps. So staggered would be a better approach as you get the advantage of this volatility as you build position. Ravindra, am I audible? Ravindra, I think your screen has frozen for me. So,
Yeah, am I audible?
yes,
Actually,
now
I
Ravindra, you're audible. Yes.
got disconnected.
Yeah, yeah.
Okay. Chetan, after this, if you can give closing remarks regarding the quarterly update call.
Yeah, so I think in a nutshell, what we are witnessing, like I mentioned, is expect a higher degree of volatility in the near term. We are confident of earnings delivery that happens in FY26, particularly in the second half. While we'll have to deal with the volatility that plays out both from news flow that is emerging from US in particular, and the way liquidity is playing out in the marketplace in the near term. So we continue to be confident of earnings delivery, where what we believe is we'll have to get over this period of near-term volatility. Having said that, I think corrections will provide an opportunity to stagger investments into the portfolio. What we are trying internally to do is to rejig the portfolio and move it towards sectors and pockets where we believe that the confidence of earnings delivery from a medium to long-term perspective remains high. The divergence in earnings growth itself should mean that over a medium to long term, you start to see a divergence in return delivery as far as the portfolio is concerned. I think Ravinder is having certain technical difficulties. With this closing remark, we would like to end this call here. I would like to thank everyone for attending this call. If there are any more questions, clarifications, please feel free to reach out to us. We would be more than happy to answer those questions and clarifications. Thank you so much, everyone, for joining us for this quarterly update call for EOP.